Ever wondered about the exclusive world of private aviation? It's often seen as, the absolute pinnacle of luxury, speed, exclusivity, bespoke travel.
Mm-hmm. A whole package.
Right.
Right.
But what happens when a company that built its whole identity in this high-flying sector makes a really dramatic strategic pivot, suddenly aiming for a totally different kind of riches. Underground riches, actually.
A big shift.
Exactly. Today, we're taking you on a deep dive into Volato Group, Inc. That's ticker SOAR. A company that has definitely been on a turbulent, but I have to say, a really fascinating flight path. We've gathered quite a stack of compelling sources for you. Everything from detailed financial metrics, ownership structures, who owns what,
right,
to the latest news headlines about their big moves. Our mission today is to really begin and pull out the most important nuggets of knowledge, the key insights about Volato Group, a company that started with, premium private jets, and is now taking this monumental leap into critical minerals. It's quite the story. Unexpected turns, bold moves. We're here to help you make sense of it all. Okay, so let's unpack this journey. Start at the beginning. Who exactly is Volato Group, Inc.?
Right.
Well, the company was founded pretty recently, actually, January 7, 2021, by Matthew DeLiotta and Nicholas Cooper. They're based out of Chamblee, Georgia.
Huh.
And initially, they planted their flag firmly in the airports and air services sector, specifically focusing on private aviation.
That niche market.
Exactly. Trying to be a modern, kind of agile player in a very exclusive, very high-touch market.
Yeah, originally, Volato's business model, it was designed to be pretty comprehensive. Services for the private jet traveler, but also for the aircraft owner, too.
Oh, brilliant.
So they had various aircraft ownership programs, ways for people or businesses to own part of a jet without, the full burden of buying and maintaining it.
Dixon.
Beyond that, they did the on-demand sort of ad hoc charter flights.
Right.
For when you just need a one-off private flight.
Right.
And they also managed aircraft for owners.
Yeah.
Handled crewing, maintenance, all that stuff.
Got it.
And to make it maybe a bit more accessible, structured, they introduced fractional ownership. Think of it like a timeshare, but for a jet.
Okay.
You own a percentage, get a certain number of flight hours, spreads the cost. They also offer jet cards, deposit programs. And their fleet, it prominently featured two main types. The Honda jet, which is super efficient, and the Gulfstream G280, which is bigger, longer range. The Honda jet fractional programs, those were specifically optimized for up to 4 passengers, and they had this interesting revenue share thing for owners.
Oh, really?
Yeah, which was quite attractive, helped offset those big operating costs.
Okay, so when we look at the company now, its current snapshot, it's still, pretty small scale, isn't it?
Yeah, definitely.
Our latest data shows Volato reported only 12 employees, which gives you a sense of just how lean their operation is. And a market cap hovering around $10.1 million.
Tiny.
Right. Puts it firmly in microcap territory. Highlights that niche presence in the broader air transportation non-scheduled industry. It's not some sprawling legacy airline.
No, not at all.
More like a specialized boutique player, catering to a very specific high-end segment, which, has its benefits, agility, but also challenges with scale and market clout.
Yeah.
Okay, so with that picture, their origins and size, let's zoom out and see how the market is actually valuing this company.
Right, the dollars and cents.
As of August 28th, the stock closed at $1.80. Had a modest little gain that day, 2.27%. But here's where it gets, really interesting. Looking back since the IPO, which was January 21, 2022, Volato's stock has seen some truly wild swings. It looks more like a theme park ride than a smooth flight path.
Yeah, white knuckle is a good description. The numbers definitely tell a story of turbulence for anyone holding the stock. Over the past year, for instance, it's down a staggering 82.86%.
Wow.
And even just year to date, it's fallen 70.61%. Now, you mentioned recent momentum up about 17% in a week, 24% in a month. That's true.
Yeah.
But, and this is crucial, these gains are coming off a very low base. To give you context, the 52-week high was 19.06 cents.
$19.
Okay. Yeah. Meaning it's currently trading at a jaw-dropping 90.56% discount from that peak.
Incredible.
The 52-week low, on the other hand, was $1.14. So it's up about 58% from that absolute bottom. Now, that beta of 0.88, usually that suggests it moves less than the market.
Right.
But here, I suspect it's more about its correlation being lower because its moves are driven by company-specific stuff, you know? The amplified swings you see are probably tied to the news, the big pivot we'll get into, not just market trends.
So it's its own beast, really.
Exactly. For you, this means its price is super sensitive to its own story. Deep research on the company itself is key, not just following the market. It definitely signals a higher risk profile.
And just to paint a clearer picture of that volatility, the ATR, the average true range, it's at 0.18. Volatility range between like 9.4% and 10.8%. So think of ATR like a daily movement gauge. An ATR of 0.18 on a $1 ADS stock suggests daily swings of, well, easily 10% or more. Reinforces the idea this isn't a stock for the faint of heart.
Yeah.
But maybe opportunities for active traders watching closely. And risks, of course.
Absolutely. Both sides of that coin. Now, digging into valuation. Market cap, $10.1 million. Enterprise value, $7.01 million. As you said, firmly microcap.
Right.
The fact that the enterprise value is lower than the market cap, often that points to maybe more cash than debt on the books. Or other adjustments.
Right.
But we need to really look closer at the balance sheet details to be sure, especially given the liquidity issues we'll touch on.
Now, you might notice, listeners, that several key valuation ratios, things like PE, forward PE, PEG, price book, price-free cash flow, they're listed as just a dash or even negative.
Yeah, quite a few blanks there.
So what does that absence or negativity mean for you?
Yeah.
Well, the lack of a meaningful PE ratio, for instance, usually tells you that the company isn't currently profitable. You can't divide price by zero or negative earnings, right?
Right.
So that immediately signals Volato's been struggling to generate net income consistently.
Yeah.
Fits with other metrics we'll get to, shows they're still striving for that positive bottom line.
However, we do have some sales-based metrics, and these offer a different, maybe more telling angle on market sentiment. The price-sales ratio, PS, is exceptionally low at 0.11.
0.11.
Yeah. And the enterprise value sales, EV sales, is even lower at 0.08. Now, put that against their reported revenue, trailing 12 months, of $92.03 million.
That's substantial revenue for a $10 middle market cap.
Exactly. That incredibly low PS compared to the revenue creates this huge disconnect. For you, this signals extreme market skepticism. It's like the market is shouting, we don't believe this revenue is sustainable or that you can turn it into profit long term.
Okay.
Combine that with the negative equity and high short interest we'll discuss. It paints a picture of a company really fighting for market credibility despite those top-line sales figures. The question isn't just if they're undervalued, but why the market feels this way.
Okay, but on a slightly brighter note, within valuation, we do see an EBITDA of 2.61.
Yes, that one's positive.
So this suggests the company's operating earnings before interest, taxes, depreciation, amortization are, well, reasonably valued against its enterprise value.
It can be a good sign, yeah. Shows the core operations might be generating some cash flow before all those other big expenses kick in.
Right, the non-operating stuff.
Exactly. But it's crucial to remember it doesn't capture everything. We still need to place it in the context of overall profitability and, crucially, whether they can actually turn that EBITDA into real net income.
Okay, let's talk about the core of financial health then. Profitability and efficiency. The actual bottom line. Volato reported sales, as you said, $92.03 million. Pretty substantial for their market cap, hints at a lot of activity. However, their income is negative $2.37 million. And earnings per share, EPS, over the trailing 12 months is negative $3.93. Yeah. So for you, this is the critical point. Despite generating all that revenue, they're spending more than they earn, resulting in a net loss. It's not a small dip either. It indicates that for every dollar of service they provide, they're currently losing money. Signals a fundamental challenge in the business model's profitability right now.
And digging into the margins helps us understand why they have that net loss. We see a gross margin of 16.34%.
Okay.
And an operating margin of 2.52%. So these suggest, okay, they are making some profit on their core services after the direct cost, that's the gross margin.
Right.
But then operating expenses eat significantly into that, leaving only a tiny slice as operating profit. And then the overall profit margin of negative 2.58% confirms the net loss after everything else, interest, taxes.
Got it.
What's fascinating, though, is having a positive operating margin but a negative net profit margin. It strongly suggests other big expenses, like interest on debt maybe, or non-operating items, are dragging them into the red overall, preventing them from reaching actual profitability.
And the return metrics really hammer this home, painting a stark picture of financial strain. Return on assets, ROA, is negative 13.76%.
Not great.
And return on equity, ROE, is a staggering negative 398.23%.
Whoa. Negative 398%.
Exactly. These are really strong indicators of inefficiency, substantial losses. That incredibly high negative ROE especially often points to negative equity liabilities exceeding assets or just exceptionally high leverage relative to equity.
Yeah.
It unequivocally signals major financial headwinds.
And yeah, our data confirms exactly that. The book value per share is negative $1.53.
There it is.
That's the definition of negative equity. It directly explains that sky-high negative ROE you just mentioned.
Right.
Negative equity isn't just some accounting term. It's a serious financial problem.
Right.
It literally means total liabilities are greater than total assets. For you, as a potential investor, this is critical because it fundamentally eats away at shareholder value. Worst case, in liquidation, there's nothing left for equity holders after paying debts. Plus, it makes getting traditional loans incredibly hard. Lenders see it as super high risk, often pushes companies towards selling more stock, which dilutes existing shareholders, or finding more expensive alternative funding. It raises that big question. How sustainable is this without a major operational turnaround or a big capital injection to fix the balance sheet? It's a critical hurdle.
Okay, shifting gears slightly to growth. Let's look at the trajectory, and here we see this kind of compelling duality. Historically, the EPS over the past, say, 3 to 5 years shows a massive decline of negative 345.16%.
Yeah, that's a deep hole.
It's a huge red flag. Indicates a severe, sustained drop in earnings over recent years. Signals they've been facing pretty deep-seated challenges for a while.
However, and this is a really critical nuance if we connect it to the bigger picture, the EPS on a year-over-year basis, trailing 12 months, is actually up 97.34%.
Oh, wow. Okay.
And EPS quarter-over-quarter is even better, up 100.36%.
So a big recent jump.
Exactly. While the past was tough, these recent figures suggest a sharp, very recent reversal. A clear move toward improving profitability. This is potentially a crucial turning point. Lines up with some of the positive news we'll discuss shortly. It's like a tale of two time frames. Historical pain, but recent, strong, positive momentum in earnings.
And we see a strikingly similar pattern with sales, which kind of reinforces this turnaround narrative.
Yeah.
Sales year over year, trailing 12 months, down negative 9.49%. Suggests a dip over the full year.
Mm-hmm.
But very encouragingly, sales quarter over quarter are up 64.27%.
Huge quarterly jump.
Right. Again, points to maybe a recent turnaround in revenue generation. Shows that despite the negative trend over the whole trailing year, they're finding some significant traction more recently.
It's also worth noting that the forward-looking estimates, EPS, next year, next 5 years, they're all listed as land.
Right. No analyst numbers.
Yeah, it just means there aren't readily available consensus analyst estimates. Not uncommon for smaller companies, especially ones going through big strategic changes like Volato. But for you, it means it's harder to gauge the future based on what Wall Street thinks. You have to rely more on the company's own guidance, their plans, and your own read of the data.
Okay, this tight liquidity situation combined with the negative equity, it brings us to the crucial question of debt. Let's pivot to the balance sheet, and liquidity always critical for a company's health. Cash per share is $0.84.
Okay, some cash there.
Which provides some immediate liquidity, yeah. But with the company's negative income that we just talked about, cash burn is always a major concern.
Definitely.
Having cash is good, but if you're consistently losing money, that cash can vanish pretty quickly, erodes any safety net.
And the liquidity ratios really highlight this challenge. Both the quick ratio and the current ratio are 0.53.
0.53, that's low.
Very low.
Yeah.
Typically, you want a current ratio above 1.0. A quick ratio may be 0.8 to 1.0 or higher. Your ratio of 0.53 means current assets don't fully cover current liabilities.
Right.
Strongly suggests potential liquidity challenges and urgent need for very careful cash management. It raises the question, how are they managing short-term obligations, paying bills? Especially as they're embarking on this huge new venture. It's like walking a tightrope. Needs constant attention.
And as for debt itself, debt to equity and long-term debt to equity are both listed as...
Which tells its own story.
Exactly. That absence of calculable ratios isn't just missing data. It's a direct result of that negative equity we discussed. When equity is negative, these standard debt ratios become meaningless. Mathematically.
Right.
It signals a really challenging financial structure for lenders, for investors. There's just no positive equity cushion against the debt.
Okay, let's shift focus now to who actually owns a piece of Volato, because this gives us really critical insights into market confidence, alignment of interest.
And here's where the plot thickens even more. Insider ownership stands at a remarkably high 53.98%.
Wow, over half.
Over half. So a huge chunk of the company is owned by its executives and directors, the people running the show. Now, what does this mean for you? Well, high insider ownership can be a double-edged sword.
Sure.
On one hand, it often suggests management's interests are closely aligned with shareholders. They have significant skin in the game. They win when you win.
Right, the alignment argument.
But on the other hand, it can limit the stock's liquidity, the number of shares easily traded, and it might make it less attractive to big institutional investors who like a larger, more liquid float to buy into without moving the price too much.
And in stark contrast to that huge insider ownership, institutional ownership is tiny, just 0.53%.
0.53%. That's incredibly low.
Exceptionally low for a public company. Connecting this to the bigger picture, it implies very few large funds, pension funds, institutions are currently invested in SOAR.
Why is that, do you think?
Could be several reasons. Its microcap status, often too small for big funds, its past financial performance and the risks involved, or even that high insider ownership we just mentioned makes it harder for institutions to build a meaningful position.
Right.
Whatever the reason, it signals a real lack of broad institutional validation at this point.
And our sources also confirm no whale activity for this ticker.
No big fish moving in or out.
Exactly. Meaning no significant recently reported changes in holdings by large institutional investors. Reinforces that low institutional interest. It's clear the big players are mostly watching from the sidelines right now, either waiting for more clarity or just avoiding the risks.
Now let's look at what the insiders are actually doing with their shares. Actions speak louder than words, right?
Mm-hmm.
Our sources show some recent insider selling activity. Nicholas Cooper, he's the director and the chief commercial officer.
Okay, key player.
Yeah. He made several sales in June 2025, reported in July, and also back in December 2024. For example, June 2025. Sold over 21,000 shares at $1.27, another 3,000 plus at $1.38, 1,800 at $1.29. And there's a larger sale, almost 460,000 shares at just 0.26 cents back in December 2024.
That raises questions.
It does. For you, pondering this, while selling can always be for personal reasons, diversification, taxes, consistent selling by a key insider can sometimes signal maybe a lack of confidence. Especially if the company is putting out positive news or making big strategic moves, it's definitely something to watch given the stock's performance.
So, okay, we see a key executive selling a decent number of shares. But then on the other hand, Matthew Liotta, the CEO,
Right, the founder.
He's been exercising options. Did this in February and December 2024, converting options into shares at really low costs, like 0.75 cents and 16 cents.
Okay, so exercising, not selling necessarily.
Right. These actions seem kind of mixed, don't they? How do you interpret this apparent difference, especially with the recent positive news and this huge strategic shift happening?
It's interesting. Exercising options is often seen as positive. It implies the executive believes the stock will go up, so they want to lock in those shares.
Mm-hmm.
Now, it's not quite the same as buying shares on the open market with fresh cash, but it still shows commitment to holding equity, even if at a good price. Suggests belief in the long-term value, maybe. Even while another insider is cashing out some shares, it's a bit contradictory.
And here's another interesting detail that caught our eye, adding another layer to this ownership story. Michael T. McCall, a Republican House member.
Oh, okay. Congress.
Yeah. He made two purchases of SR stock back on September 19th, 2023. One in the $1,000, $15,000 range, another $15,000, $50,000.
Interesting timing.
While he's not a company insider, it does highlight specific interest from a governmental figure in Volato's prospects around that time. Or just reporting the facts, of course. No further implications intended. But it adds to the intrigue of who sees potential here.
Okay, finally, let's look at short interest. This tells us about people actively betting against the company.
Right, the short sellers.
The short float is quite high, 24.68%.
Wow, nearly a quarter of the float.
Exactly. Means a significant chunk of the freely tradable shares are currently borrowed and sold by investors betting the price will fall. A high short float like that usually suggests considerable skepticism in the market about future prospects. Indicates many pros see significant downside risk.
However, there's an important counterpoint here, something that sometimes dampens the impact of high short interest. The short ratio is only 0.24.
Very low ratio.
Very low. This ratio tells us how many days it would theoretically take for for all those short sellers to buy back their borrowed shares, given the average daily trading volume.
Right, the days to cover.
Exactly. A very low ratio like 0.24 means even with that high percentage of shares shorted, they could cover their positions extremely quickly if the stock price started to spike.
So less chance of a classic short squeeze.
It mitigates the potential for a dramatic short squeeze, yeah? Or at least indicates the short positions are very liquid, can be unwound fast without necessarily causing a huge price surge. So, while skepticism is high, the market seems liquid enough that those skeptics aren't necessarily trapped if things turn positive. Okay, let's unpack this major development. This is the thing that has truly reshaped Volato's story and honestly defines where they are right now.
The big pivot.
The big pivot. In the last few months, Volato announced a transformational merger, a definitive agreement to acquire M2I Global. Now, this isn't just some small bolt-on acquisition.
No, far from it.
This marks Volato's audacious entry into the $320 billion critical minerals market.
Huge.
Huge. It's a massive leap from flying high in luxury jets to digging deep in the earth for essential resources. It's almost like they're trying to win the corporate Ironman, first swimming in aviation, now a full marathon in mining. It's unexpected.
The stated reason, the rationale they gave, is to unlock value through industrial scale and platform independence. News from August 25, 2025 specifically mentioned Volato and M2I are set to develop strategic minerals reserve in Nevada, U.S.
Right, in Nevada.
Connecting this to the big picture, it's just a dramatic strategic pivot. Moving the company not just adjacent, but completely beyond its origins in private jets into an entirely different industrial sector, critical minerals. These are things essential for EVs, renewables, electronics, defense.
Just for important stuff.
Geopolitically strategic. So it raises this massive question for you. What does a private jet company, experts in service, logistics, aviation, what do they know about mining? Mineral extraction, processing, complex supply chains.
That's a fair question.
How will this new venture integrate? Or will it just completely overshadow the old business? It's incredibly bold, demands totally new expertise, huge amounts of capital, different risk management. The challenges are immense geology, environment regs, raising capital, volatile commodity prices.
And amidst this colossal pivot, Volato's also been busy tidying up its finances, almost like preparing for this even bigger journey ahead. They delivered strong Q2 earnings, reported August 14th, 2025.
Good timing.
And they're accelerating debt reduction ahead of transformational merger. This points to a very deliberate and necessary effort to clean up the balance sheet, which is absolutely crucial when you're about to embark on a huge acquisition that will definitely need substantial capital.
Makes sense. Get leaner before the big move.
They also reported over $20 million in debt reduction in Q1 2025, according to news back on May 15th. Seems like they're really trying to get their financial house in order, lighten the load before diving into critical minerals.
And further supporting this financial cleanup, Volato sells GC Aviation for $2 million on June 30th, 2025. The stated goal was strengthening focus on scalable platform growth.
Okay, shedding non-core assets.
Exactly. They're also targeting additional settlements and capital raise to extend operating runway. These moves clearly suggest divesting things that aren't central, freeing up cash, and proactively trying to shore up finances. Super important given the negative profitability and negative equity we discussed earlier.
Right.
They're actively working to improve that financial foundation, seeking runway to execute this new ambitious strategy. It feels like a direct response to those financial challenges we outlined.
And here's an interesting piece of news that ties directly back to those recent positive quarterly EPS numbers we noted. Volato projects full-year profitability on strength of Q1 execution and expanding revenue streams. That was as of June 5, 2025.
Projecting profitability, okay.
They even reported positive net income in Q1 2025 back on May 15th. This really aligns with that recent positive EPS quarter-over-quarter growth we saw. Suggests a genuine turnaround on the profit front within their existing aviation business.
Right, the legacy business.
Even before the full impact of the M2I merger kicks in. It seems their original aviation business, despite the pivot, is maybe starting to hit its stride financially, generating some much-needed cash.
Yeah, indeed. And throughout 2025, late 2024, Volato's Vaunt platform, that's been a consistent bright spot, showcasing strength and innovation within that original aviation business.
The app, right.
Right. News reports 85% sequential growth in subscription sales on June 17th, 2025. Huge user adoption. They're deepening member loyalty as of May 29th. The platform surpassed $1.05 ARR in first year, 100,000 downloads by February 20th. Achieved 50% ARR growth back in November 24.
So Vaunt was actually doing pretty well.
It clearly seems to be a strong, growing segment, demonstrates a successful digital strategy in private aviation, which, frankly, makes the pivot raise a fascinating strategic question. Why dilute focus from, or potentially abandon, a growing, innovative segment like Vaunt, showing positive cash flow, strong subscription growth for an entirely new, super capital-intensive venture in minerals?
Good point.
Is it a sign that even the successful bits of aviation weren't enough for the scale or profit they needed? Or is it a calculated gamble to reallocate resources to a market with maybe explosive but still unproven returns for them?
And Vaunt wasn't just growing numbers. It was adding features, expanding its network, really solidifying its position. Added stuff like Complete the Trip and a travel center on March 11th, 2025, signaling a move towards more comprehensive travel solutions.
More than just booking jets.
Exactly. News on March 27th said Vaunt moves beyond private jet booking with end-to-end travel capability, positioning it as broader travel tech. Plus, it doubled aircraft network with expanded operator program on March 20th. And a really strong sign, marked its first cash positive month back in April 2024.
Cash positive is key.
Yeah. This platform really seems like a shining star in their aviation tech segment, showcasing internal innovation even as the company looks towards, well, digging in the dirt. In terms of their traditional fleet, the actual planes, Volato kept investing there too, right up until recently, it seems. Took delivery of second G280 February 6, 2025. Had plans for another second Gulfstream G280 in January 2025.
Expanding the fleet.
They also reported expanding their HondaJet fleet by 50% to 24 aircraft back in December 2023. These additions suggest they were actively investing in core aviation assets, growing capacity either right before or maybe even alongside the early stages of the minerals pivot idea.
And beyond just buying planes, they were busy with partnerships, new programs in aviation, launched the first fractional G280 ownership program in the United States July 30, 2024, innovating in their high-end offerings. Expanded maintenance capabilities with Banyan Air Service in January 2024, crucial for efficiency. Plus, initiated an aircraft trading program and a new leasing initiative on June 3, 2025, both designed to expand revenue, optimize asset use in the core aviation business, suggest continuous innovation, operational focus within that original segment, even as this massive critical minerals pivot looms, creates a really complex dual narrative for the company's future, doesn't it?
Now, on the, let's say, less exciting but important stuff, compliance and governance. Volato wasn't without challenges there. Always important for investor confidence.
Gotta follow rules.
Right. They faced some non-compliance issues with NYSE American rules. But, good news, successfully resolved non-compliance with NYSEs on December 25, 2024.
Okay.
That followed an earlier announcement, acceptance of compliance plan by NYSE American back in September 2024. So it indicates they're actively addressing regulatory stuff, successfully keeping their public listing, which is crucial for accessing capital markets, maintaining trust.
And in another notable governance-related move, they withdrew their S1 registration statement on December 9th, 2024.
Ah, the S1 withdrawal. What does that signify?
Well, an S1 is the big filing you do before selling new stock to the public, like in an IPO or a follow-on offering. Withdrawing it, as Volato did, suggests a change in their plan for raising capital.
Okay.
Maybe they found other ways to get money, perhaps less dilutive, or maybe their improving financial outlook, which they mentioned alongside the withdrawal, anticipating positive Q4 net income, meant they didn't need to pursue that specific public offering right then.
Interesting.
It signals a shift in how they plan to fund things, possibly influenced by that improving profitability, letting them finance operations, or maybe the M2I deal through other means.
Okay, now let's take a quick look at what isn't prominently featured in our sources, because sometimes what's missing tells a story too.
Yeah, the gaps can be revealing.
Our sources indicate no corporate lobbying instances for this ticker, and no government contracts for this ticker, nor any estimated quarterly amount awarded from public contracts.
Interesting.
It is interesting, right? For a company in aviation, even private, you might expect some interaction with government, maybe advocating on regulations or specific contracts, but it seems not to be a significant part of Volato's reported activity. Suggests maybe a more self-reliant approach, or perhaps just less politically engaged, at least publicly.
Similarly, there are no new patents for this ticker reported.
No new patents.
Yeah. Now, that's not necessarily bad for every company, but for a business in sectors that often involve high-tech stuff like aviation or now critical minerals, a lack of new patent activity could suggest less emphasis on developing proprietary tech recently, or at least nothing new filed publicly.
So maybe their innovation is elsewhere.
It raises the question for you. Does their innovation come more from service models, platform development, like we saw with Vaunt, rather than hard IP, patented tech? Or is the new minerals venture just too new to have generated anything patentable yet? It's hard to say for sure from the outside.
We also noted the absence of publicly available analyst ratings or price targets in our sources.
Yeah, the analysts aren't covering it much, it seems.
Which, again, isn't uncommon for smaller microcap companies like Volato. They often fly under the radar of Wall Street research departments.
True.
But what it means for you as a potential investor or just an observer is you're relying less on that Wall Street consensus view. You're leaning more on your own interpretation of the raw data, the news, the company's strategy.
Puts more weight on individual research.
Exactly. Requires more homework and personal conviction.
So, okay, let's try to connect all these disparate threads. What does it all mean? Volato Group, Inc. presents this fascinating, almost paradoxical picture. A company undergoing truly significant transformation. On one side, you have the initial core business, private aviation, niche services, fleet expansion, that growing digital platform, Vaunt. And that segment, as we've seen, has shown recent signs of actually turning profitable, showing operational strength. Suggests the original strategy was starting to work, even generate cash.
But then, boom, there's the bold, almost audacious pivot into critical minerals through the M2I global merger.
Totally different world.
Totally different. A massive strategic shift. Aiming for a much larger market, yes, that $320 billion critical mineral sector, but also introducing entirely new business risks, huge capital needs, operational complexities miles away from aviation. It really is like a seasoned pilot suddenly deciding mid-flight to become a deep-sea diver.
Yeah, that's a good analogy.
Requires a whole new skill set, different expertise, new equipment, a fundamental rethink of the risks involved. The question isn't just if they can do it, but how they'll bridge that huge gap in expertise and funding.
And financially, you see this distinct duality playing out. On one side, the history, losses, tough liquidity ratios, and critically, that negative equity, a really profound financial challenge.
Right, the baggage.
But juxtaposed against that, you have recent significant improvements.
Right.
Quarterly EPS, turning positive, reported positive net income, aggressive debt reduction, selling off assets. Now, those extremely low sales multiples, PS, EV sales compared to their substantial revenue, paired with that relatively high short interest, it might suggest the market just isn't fully buying the positive turnaround story yet, or sees major hurdles ahead despite the high insider ownership. It's almost like the market's saying, okay, nice headlines, but prove it to us.